The global silver market isn't unstable. It's already broken. The fracture happened January 1st, 2026. You just haven't felt it yet because the system is designed to hide structural failure until the exact moment collapse becomes irreversible. And that moment is now measured in weeks. China didn't gradually tighten silver exports. They erased 250 million ounces from planetary supply in a single administrative stroke. Overnight. Gone. Yet the COMEX in New York still prices silver at $71 per ounce, as though that metal exists, as though it will arrive when demanded, as though nothing fundamental changed. This is not a pricing error. This is a mathematical impossibility wearing the mask of normalcy, and the mask is about to come off. COMEX holds two inventory classifications. Eligible silver sits in warehouses, but cannot fulfill contract delivery. Registered silver is pledged metal, the actual ammunition behind every paper promise traded in the futures market. In May 2020, registered inventory stood at 102 million ounces. January 2026, 31 million ounces. A 70% collapse while open interest, the total outstanding contracts, sits at 140 million ounces. Each COMEX silver contract represents 5,000 ounces. With 28,000 contracts open and only 31 million ounces registered, you're looking at 4.5 paper claims for every ounce of physical metal. 4.5 people holding deeds to the same house. Has this ratio ever existed without triggering default? No. Never. Not once in COMEX history. During the 1980 Hunt Brothers crisis, the paper-to-physical ratio hit 3. One in COMEX rewrote the rules overnight to prevent systemic collapse. In 2011, when silver spiked to $49, the ratio touched 3.5. One and the exchange raised margin requirements 5 times in 8 days to force mass liquidation. We are now 30% beyond the most dangerous ratio ever recorded, and the price still says $71. This is no longer a market. This is a countdown. Now layer in what just activated on New Year's Day. China's Non-Ferrous Metals Industry Association confirms Chinese refiners produced 280 million ounces of silver in 2025, making China the world's largest producer. But China's new export licensing system requires detailed documentation, government approval, and compliance verification for every international shipment. This sounds bureaucratic until you understand that 90% of Chinese silver refiners are small to mid-sized operations without the infrastructure, English documentation, or government connections to navigate this system. The major state-owned enterprises, the 10% that can comply, produced roughly 30 million ounces last year, which means 250 million ounces didn't decline gradually. It vanished. The metal exists. The legal pathway to export it does not. Consider what this does to American industrial infrastructure. Solar panel production consumed 130 million ounces of silver in 2024. Electronics manufacturing, everything from smartphones to electric vehicles, uses roughly 220 million ounces annually. Medical devices, military applications, water purification systems add another 170 million ounces. Total annual industrial demand exceeds 520 million ounces. We just lost 48% of supply while demand remains unchanged. And futures markets are pricing silver as if Chinese refineries will resume normal exports next week. This is where it turns dangerous. Look at Shanghai. December 30th, 2025. 2 days before the licensing system took effect, the Shanghai Futures Exchange physical silver premium hit $8.50 per ounce over COMEX futures. Physical buyers in Asia are paying $79.50 per ounce, while New York paper contracts trade at $71. You are watching two markets price the same metal with an $8.50 gap. This is not a temporary discrepancy that clears in days. This is the largest sustained Shanghai premium since August 2024, when refinery outages created a brief squeeze that resolved in 3 weeks. August 2024 was temporary. January 2026 is permanent structural change. The premium is telling you everything. Physical buyers with actual industrial needs are already competing for metal that isn't arriving. They're bidding higher because delivery timelines stretched from 2 weeks to 8 weeks, and they need silver to keep factories operational. Meanwhile, leveraged traders in New York are still shorting futures at $71 because the screen says supply exists. One of these markets is lying, and it's not the one where people need actual metal delivered to their facilities. When you buy silver futures, you are not buying metal. You are buying a derivative contract that promises conversion to metal if you demand it. Most traders never take delivery. They bet on price moves and close positions for cash. The system works beautifully as long as enough participants play the paper game and do not demand physical settlement. But what happens when industrial buyers who need silver for production can't get it from China anymore? They turn to COMEX. They demand delivery. And suddenly those 28,000 open contracts are not abstract financial instruments. They are legal claims on 31 million ounces of registered inventory. The math is brutal and unavoidable. If just 22% of current contract holders demand delivery instead of cash settlement, COMEX registered inventory goes to zero. Not low. Zero. COMEX warehouse withdrawal rates averaged 2.1 million ounces per week throughout December 2025. At that pace, the remaining 31 million ounces lasts exactly 15 weeks. March 28, 2026 is the mathematical 0 point. Less than 3 months from today. But it won't take 3 months for this to break because industrial buyers are not stupid. When they see Shanghai premiums hitting $8.50 and climbing, when they watch Chinese export licenses getting denied, when procurement teams report 8-week delivery delays instead of 2 weeks, they stop trusting the paper market and demand physical settlement immediately. That's when the real price discovery begins. And that's when investments, industrial supply chains, and financial system stability face a reckoning most Americans have no idea is coming. The institutions know. The evidence of their positioning is about to show you exactly how they are preparing and why they are not sharing this intelligence with retail investors who still think $71 represents fair value for silver in a world where half the supply just disappeared. When JPMorgan Chase, the largest silver derivatives trader in the world, suddenly flips a $40 billion position from massively short to massively long, you do not shrug and assume they are making a casual portfolio adjustment. You pay very close attention to what they know that you don't. According to CFTC Commitments of Traders reports, JPMorgan held approximately 200 million ounces in net short positions across COMEX silver futures during Q2 2024. This was standard. Major banks regularly short precious metals futures as part of hedging operations, market making, and client facilitation. For decades, this positioning made sense in a world where paper silver supply always exceeded physical demand. But something changed dramatically in the second half of 2025. By December, JPMorgan's positioning had completely reversed to roughly 750 million ounces net long. That is not a trim. That is not a hedge adjustment. That is a billion-dollar bet that silver prices are heading substantially higher, and soon. At $71 per ounce, a 950 million ounce swing represents $67 billion in notional exposure change. Even accounting for leverage and offsetting positions, we are looking at roughly $40 billion in directional repositioning by a single institution. Banks do not make $40 billion bets on hunches. They make them on certainty, and the timing of this flip, accelerating heavily from September through December 2025, suggests JPMorgan's trading desk knew exactly what was coming on January 1st when China's export licensing would strangle global silver supply. Think about the information advantage. While retail investors were reading headlines about Chinese economic policy and vague regulatory changes, JPMorgan's commodity research team was likely getting direct intelligence from Chinese refinery contacts, supply chain partners, and government relations channels. They understood months in advance that 250 million ounces would disappear from global markets, and they positioned accordingly before the news became obvious to everyone else. This is how institutional players operate in commodity markets. They do not wait for CNBC to explain why silver is moving. They are already positioned before the catalyst becomes public knowledge. But JPMorgan is not the only institution that made dramatic changes to precious metals exposure in late 2025. According to World Gold Council data, central banks increased gold purchases by 22% in Q3 2025 compared to Q3 2024, with China's People's Bank adding 63 tons to official reserves. Turkey added 39 tons. Poland added 25 tons. Why does gold buying matter in a story about silver? Because central banks do not accumulate physical precious metals based on Western paper market pricing. They accumulate based on geopolitical intelligence about monetary system fragility and supply chain disruption. When central banks globally accelerate physical metal acquisition, they are signaling they do not trust the stability of current market mechanisms. And here's the pattern that should make every American investor deeply uncomfortable. We have seen this movie before, and it does not end well for people who trust that institutions will play fair when physical scarcity threatens paper market control. Go back to 2018. Venezuela held 31 tons of gold in the Bank of England's vaults as part of its sovereign reserves. In November 2018, as Venezuela faced economic crisis and U.S. sanctions, President Maduro requested repatriation of this gold. It was Venezuela's gold, held in custody, with clear legal ownership. The Bank of England simply refused to release it. The official justification involved sanctions, compliance, and questions about government legitimacy. But strip away the political narrative and look at what actually happened. A Western financial institution seized 31 tons of physical gold belonging to a sovereign nation, and that gold remains locked in London vaults today, 7 years later. Now ask yourself a fascinating question. Why does COMEX registered silver inventory currently sit at 31 million ounces, which equals approximately 965 tons, while Venezuela's confiscated gold totaled exactly 31 tons? Is it coincidence that the same number appears in both situations where physical metal availability creates systemic stress? Probably. But it's the kind of coincidence that reveals how institutions think about precious metals when scarcity threatens. They do not see metal as property. They see it as liquidity that can be controlled, withheld, or repositioned based on political and financial convenience. The Venezuela gold seizure established a clear precedent. When physical metal becomes scarce enough to threaten Western financial system stability, institutions will change the rules, freeze assets, or simply refuse delivery regardless of legal ownership claims. The Bank of England did not care about property rights. They cared about maintaining control over physical reserves during monetary stress. That same institutional mindset governs COMEX silver today. The exchange exists to facilitate paper trading and price discovery, not to guarantee physical delivery to every contract holder. And when physical scarcity threatens paper system stability, we know exactly what happens because we watched it play out in real time during the 1980 Hunt Brothers crisis. March 1980. Nelson Bunker Hunt and William Herbert Hunt had accumulated roughly 100 million ounces of physical silver, driving prices from $11 in September 1979 to $50 in January 1980. They were taking delivery on futures contracts, removing physical metal from COMEX warehouses, and exposing the fractional reserve nature of the entire futures system. COMEX's response was swift and devastating. On January 21, 1980, the exchange implemented Silver Rule 7, which dramatically increased margin requirements and prohibited new long positions except for liquidation purposes. Then in March, they raised margin requirements from 10% to 100% overnight. A tenfold increase that forced leveraged longs to either deposit massive additional capital or liquidate positions. The Hunt brothers could not meet the margin calls. They were forced to liquidate. Silver crashed from $50 to $10 in a matter of weeks. And here is the critical lesson. COMEX did not care about market fairness or property rights. They cared about preventing a delivery default that would expose the paper to physical ratio as unsustainable. Fast forward to 2011. Silver hit $49 per ounce in April as investors flooded into precious metals during post-financial crisis monetary expansion. Once again, physical delivery demands started stressing COMEX warehouse supplies. The exchange's response: 5 margin requirement increases in 8 trading days, forcing leveraged longs to liquidate and crashing prices from $49 to $26 in 2 weeks. See the pattern? When physical delivery threatens paper market stability, exchanges do not honor contracts. They change the rules to force liquidation and protect the system. Now we are heading into an identical setup, except the catalyst is not speculators accumulating metal. It is China permanently removing 250 million ounces from global supply while industrial demand requires 520 million ounces annually. This is not a Hunt Brothers squeeze that resolves when margin requirements rise. This is a structural supply deficit that requires real price discovery to destroy marginal demand or incentivize massive scrap recycling. But before that price discovery can happen, COMEX faces the same institutional choice they faced in 1980 and 2011. Honor delivery obligations and risk warehouse depletion, or change the rules to protect the paper system. Current Regulation T margin requirements for COMEX silver futures sit at 50%. That means traders can control $100,000 worth of silver with $50,000 in account equity. If COMEX follows the 1980 playbook and doubles margin requirements to 100%, every leveraged long position faces an immediate margin call requiring them to deposit additional capital equal to their entire position value or liquidate. Think about the timing. January 9th through 14th marks the Bloomberg Commodity Index quarterly rebalancing. Institutional allocators who track this index need to increase silver exposure from 6.1% to 8.5% weighting, a shift requiring approximately $4.2 billion in silver purchases based on total index assets. But COMEX registered inventory of 31 million ounces equals only $2.2 billion at current prices. The math does not work. Institutional buyers will compete for physical metal that simply does not exist in sufficient quantity at $71 per ounce. What happens when institutional allocators realize they cannot get delivery? They will demand either emergency ETF premium structures that source metal outside COMEX, or they will accept cash settlement at higher reference prices that reflect actual physical scarcity. Either outcome breaks the current price control mechanism, and that is when COMEX faces the same decision they faced in 1980. Change the rules before the system breaks, or honor contracts and watch registered inventory deplete to zero. We know which choice they will make because we have seen this story twice before. The only question is whether they act preemptively during the January 9-14 rebalancing chaos or wait until warehouse withdrawals accelerate and force their hand in February. But here is what is different this time, and why JPMorgan's $40 billion position flip matters so much. In 1980 and 2011, the supply shortage was artificial, created by speculative accumulation that could be broken by rule changes. In 2026, the shortage is structural, created by China's export licensing removing real production capacity from global markets permanently. You cannot margin call China into exporting silver they have legally restricted. You cannot force 250 million ounces to materialize through paper market manipulation. This time, the only resolution is real price discovery that either destroys industrial demand or incentivizes enough scrap recycling to replace lost Chinese supply. JPMorgan knows this. That is why they flipped to net long before retail investors even understood the Chinese licensing implications. They have seen the refinery data. They have modeled the supply deficit. They know COMEX warehouse depletion rates make current pricing mathematically unsustainable, and they are positioned to profit enormously when the paper market finally admits what the physical market already knows. Silver at $71 is a fantasy price that exists only because most traders have not demanded delivery yet. The institutions are not sharing this intelligence with everyday investors. They are quietly accumulating while the screen still says $71, knowing that when awareness spreads and delivery demands surge, that price will look quaint in hindsight. Let's do the math that institutions do not want retail investors to figure out, because once you see these numbers, you will understand why JPMorgan repositioned $40 billion and why the next 12 weeks will determine whether COMEX maintains credibility or suffers its first precious metals default since the 1933 gold confiscation. COMEX registered silver inventory currently sits at 31 million ounces. Throughout December 2025, warehouse withdrawals averaged 2.1 million ounces per week. This is not speculation. This is documented, publicly reported inventory movement that anyone can verify. At 2.1 million ounces per week, we are looking at 8.4 million ounces per month leaving registered inventory. Divide 31 million ounces by 2.1 million weekly withdrawals, and you get 14.76 weeks until complete depletion. That is March 28, 2026. Exactly 12 weeks from the January 1st implementation of China's export licensing. But here is why this timeline is actually conservative and why the crisis will likely arrive much sooner. December's 2.1 million ounce weekly withdrawal rate happened before industrial buyers fully understood the implications of China's licensing system. As procurement teams at solar manufacturers, electronics producers, and defense contractors realize Chinese supply chains are genuinely disrupted, not temporarily delayed, but structurally changed, they will accelerate COMEX delivery demands to secure metal before warehouse inventories deplete completely. Think about how corporate procurement works. If you are managing supply chains for a solar panel manufacturer that needs 5 million ounces of silver annually, and you hear that your primary Chinese supplier cannot get export licenses, what do? You immediately secure alternative supply through every available channel. You demand delivery on existing futures positions. You buy physical metal from dealers. You go directly to COMEX warehouses and take delivery rather than rolling contracts forward. When enough industrial buyers make that same calculation simultaneously, weekly withdrawal rates will not stay at 2.1 million ounces. They will accelerate to 3 million, 4 million, potentially 5 million ounces per week as companies race to secure supply before others deplete available inventory. At 4 million ounces per week, registered inventory depletes in under 8 weeks. That is late February 2026. At 5 million ounces per week, we are looking at early February. But the real catalyst that forces this acceleration is not gradual awareness. It is the January 9-14 Bloomberg Commodity Index rebalancing that creates immediate concentrated buying pressure from institutional allocators. The Bloomberg Commodity Index is increasing silver weighting from 6.1% to 8.5%, a 2.4 percentage point increase. That sounds small until you calculate the actual dollar flows involved. According to Bloomberg data, approximately $175 billion in institutional assets track this index through ETFs, mutual funds, and structured products. A 2.4% weighting increase across $175 billion equals $4.2 billion in required silver purchases during the January rebalancing window. At $71 per ounce, that is 59 million ounces of silver that institutional buyers need to acquire in a 5-day period. Now remember, COMEX registered inventory totals only 31 million ounces valued at $2.2 billion. The institutional demand required by index rebalancing exceeds available registered inventory by 28 million ounces or $2 billion. The math is brutally simple. Institutions tracking the Bloomberg Commodity Index need to buy almost twice as much silver as exists in COMEX warehouses available for delivery. This creates an immediate scramble where institutional allocators compete for insufficient supply, driving premiums on physical metal, while paper futures potentially remain suppressed through leveraged short selling. What happens when institutional buyers cannot source the metal they need to track index weightings? 3 possible outcomes, none of which maintain current price control. First, ETF sponsors could implement premium structures where shares trade above net asset value, allowing them to source metal outside COMEX at higher prices while maintaining index tracking. This breaks the COMEX price control mechanism because it admits physical metal trades at premiums to futures. Second, institutional allocators could accept cash settlement at elevated reference prices that reflect actual physical scarcity rather than paper futures pricing. This also breaks price control by establishing a higher settlement value. Third, some allocators could fail to fully track the index rebalancing, creating tracking error that forces disclosure to investors about physical silver availability constraints. This admission alone would trigger broader awareness and accelerate delivery demands across the market. All three outcomes lead to the same place: recognition that paper at $71 does not reflect physical metal availability, followed by rapid price adjustment as the market reprices based on actual scarcity. But before we even get to the Bloomberg rebalancing chaos on January 9-14th, there is another mathematical pressure point that most investors are not watching: the relationship between Chinese export restrictions and global industrial demand. The Silver Institute reported total industrial silver demand of 528 million ounces in 2024. China's licensing system just removed 250 million ounces of annual production from global export markets. That is a 48% supply deficit that has to resolve through one of three mechanisms: demand destruction, where industrial users substitute away from silver or reduce production; scrap recycling, where higher prices incentivize scrap recovery to replace lost mine supply; or inventory depletion, where existing stockpiles get drawn down until they are exhausted and the first two mechanisms kick in. Let's analyze each mechanism and the price points where they become economically viable. Solar panel manufacturers currently use silver because it is the most efficient conductor for photovoltaic cells. Alternative materials like copper or aluminum reduce panel efficiency by 15 to 20%, making them uneconomical at current electricity prices. According to industry research from the International Energy Agency, solar manufacturers would only substitute away from silver if prices exceeded $120 per ounce for a sustained period, at which point the efficiency loss becomes cheaper than the higher silver cost. That is your first price target. $120 per ounce represents the threshold where marginal industrial demand starts getting destroyed through material substitution. Electronics manufacturing faces a similar calculation, but with different economics. Smartphones, computers, and electric vehicles use silver in printed circuits, switches, and contacts where conductivity and reliability are critical. Substitution is possible, but requires redesigning products, retooling manufacturing, and accepting performance compromises. Industry analysis suggests electronics manufacturers would pursue aggressive substitution programs if silver sustained prices above $150 per ounce. That is your second price target. $150 per ounce triggers substantial demand destruction across consumer electronics. But the most important price discovery mechanism is not demand destruction. It is scrap recycling, because that is what ultimately brings new supply into the market when mine production cannot meet demand. At current prices around $71 per ounce, scrap recycling of silver from old electronics, jewelry, and industrial waste is marginally profitable, but not lucrative enough to incentivize massive collection infrastructure investment. According to the Silver Institute, scrap recovery totaled roughly 180 million ounces in 2024, a significant source, but not enough to offset the 250 million ounce loss of Chinese exports. Here is the price point that changes everything. Silver above $250 per ounce makes scrap recycling extraordinarily profitable, triggering global infrastructure investment in collection, refining, and recovery systems. At $250, old electronics become valuable enough that specialized recycling facilities can profitably extract silver from circuit boards, contacts, and solder. Jewelry scrap flows increase dramatically. Industrial users implement aggressive recovery programs for manufacturing waste. At $250 per ounce, You are looking at potential scrap recovery increasing from 180 million ounces annually to possibly 300 to 350 million ounces as economic incentives transform waste streams into valuable feedstock. That is your third price target. $250 per ounce represents the threshold where scrap recycling scales enough to potentially replace lost Chinese mine supply. So we have three mathematically derived price targets based on actual industrial economics, not speculation. $120 for solar substitution, $150 for electronics substitution, and $250 for scaled scrap recycling. Current COMEX pricing at $71 exists nowhere near any of these supply-demand equilibrium points. That is the fundamental problem. The paper market is pricing silver as if Chinese supply still exists and will flow to wherever it is needed. The physical market knows that supply is gone and prices must rise enough to either destroy demand or incentivize replacement supply. One of these markets will be proven correct, and it will not be the one built on leverage and derivative contracts. Now connect the timeline. We know COMEX registered inventory depletes by late March at current withdrawal rates, potentially much sooner if January rebalancing accelerates delivery demands. We know industrial buyers will panic as Chinese supply chain disruptions become undeniable. And we know price discovery must eventually reach $120, $250 per ounce to clear the market through demand destruction or scrap recycling. The only question is whether COMEX allows that price discovery to happen through honest futures trading or whether they implement emergency rule changes, margin requirement increases, position limits, cash settlement mandates to prevent warehouse depletion and maintain paper market control. History suggests they will choose rule changes, just like they did in 1980 and 2011. But here is why this time is different, and why even emergency rule changes will not prevent dramatic price adjustment. In 1980, raising margin requirements forced the Hunt brothers to liquidate because their accumulation was leveraged. Breaking their buying pressure allowed prices to crash. In 2011, margin increases forced leveraged speculators out, again allowing prices to crash because the demand was artificial. But in 2026, the demand is not leveraged speculation. It is industrial necessity. Solar manufacturers cannot liquidate their silver needs because margin requirements increased. Electronics producers cannot substitute away from silver overnight because COMEX changed rules. Defense contractors cannot delay military electronics production because futures markets implemented position limits. Real industrial demand persists regardless of paper market manipulation. And when industrial buyers cannot get delivery from COMEX, they will go to physical dealers, driving spot premiums. They will buy directly from miners, bypassing exchanges entirely. They will implement long-term supply agreements at premium prices. All of those alternative sourcing channels establish price discovery outside COMEX control, revealing the true market clearing price for scarce physical metal. This is why JPMorgan positioned long for $40 billion. They understand that whether COMEX changes rules or allows delivery, the outcome is the same. Physical silver prices rise dramatically because structural supply deficit requires real price adjustment to balance the market. The institutions positioned early are going to profit enormously. Retail investors who dismiss this analysis or who trusted that $71 represents fair value are going to watch their purchasing power evaporate as industrial users bid prices higher to secure supply. So what should everyday Americans understand as we watch this unfold over the next 12 weeks? First, recognize that commodity markets are not casinos where prices move randomly. They are complex systems where physical reality eventually overrides paper manipulation. China removing 250 million ounces from global supply is physical reality. COMEX maintaining $71 pricing is paper manipulation. Reality wins. Always. Second, understand that institutional players have access to information and positioning power that retail investors do not. When JPMorgan makes a $40 billion position flip, they are not gambling. They are acting on intelligence about structural changes that have not become public knowledge yet. By the time retail investors read about supply disruptions in mainstream financial media, institutions have already positioned and captured the early profit. Third, watch the specific dates that matter. January 9-14th. Bloomberg rebalancing creates immediate institutional buying pressure that tests COMEX inventory. Late January, early February. Industrial procurement teams will fully grasp Chinese supply chain disruptions and accelerate delivery demands. Late March. Mathematical depletion point if current withdrawal rates continue. Fourth, remember that the goal is not to predict exact prices or timing. It is to understand the underlying forces and position accordingly before the crowd recognizes what is happening. Whether silver reaches $120, $150, or $250 depends on how quickly industrial demand adjusts and scrap recycling responds. But all three targets represent mathematical equilibrium points based on real supply-demand economics, not speculation. And finally, recognize that this story is not really about silver. It is about understanding how financial systems work when scarcity meets leverage. The same patterns playing out in silver markets exist in other commodities, in credit markets, in sovereign debt. Institutions engineer paper control while accumulating physical advantages, then profit when reality forces adjustment. China kicked away 3 legs on January 1st. COMEX is balancing on the last one, pretending everything is stable. And in the next 12 weeks, we are all going to watch what happens when physics finally takes over and that last leg snaps. The warning signs are everywhere. The mathematics are undeniable. The institutional positioning is complete. The only question left is whether individual investors recognize the trap before it springs shut, or whether they are still sitting in the chair when it collapses.